In 2021, at the absolute peak of the NFT frenzy, YouTuber Logan Paul made a purchase that perfectly captured the spirit of that era: bold, confident, and incredibly expensive. He spent approximately $635,000 on a single NFT. At the time, it didn't seem insane. In fact, to many people watching the market explode, it looked visionary. NFTs were everywhere. Celebrities were buying them, influencers were promoting them, and collectors were flipping digital images for life-changing profits. The logic felt simple: get in early, hold rare pieces, and watch their value multiply. The NFT Logan purchased was part of a hyped digital art collection that investors believed would become culturally iconic. Rarity traits, community hype, and social media attention drove prices higher and higher. In crypto terms, he paid 188 ETH for it, and because Ethereum itself was trading high during that period, the dollar value crossed the 600,000 mark. It wasn't just a purchase, it was a statement. But to understand what happened next, you have to understand how NFT markets actually work. Unlike Bitcoin or Ethereum, which have deep liquidity and thousands of daily buyers and sellers, most NFTs rely purely on demand within a specific community. Their value isn't backed by cash flow, dividends, or utility in the traditional sense. It's driven by perception, scarcity, and cultural relevance. When sentiment is strong, prices soar. When sentiment disappears, liquidity vanishes. And that's exactly what happened. As 2021 turned into 2022, the broader crypto market entered a brutal downturn. Bitcoin fell, Ethereum dropped sharply, speculative capital dried up, and NFTs, being one of the most speculative corners of the ecosystem, were hit hardest. Trading volumes collapsed, floor prices across collections plummeted. Many projects that once seemed unstoppable simply faded into obscurity. Logan Paul later revealed the shocking reality: the NFT he bought for over $600,000 was now worth almost nothing compared to its purchase price. At one point, estimates suggested it could be valued in the double digits, from hundreds of thousands of dollars to barely the price of dinner. That's not volatility, that's vaporization. So what went wrong? First, hype cycles move faster than fundamentals. During the NFT boom, people weren't valuing projects based on long-term utility. They were valuing them based on momentum. As long as new buyers kept entering the market,